You won't need me to tell you when leadership has transitioned from gold to silver. My experience is that when silver runs, you don't need a crystal ball to understand it's running. It really, really, really runs. Is that going to happen in 2025 or 2026? I don't know. What I do know is that when it runs, whether you had to wait 2 years or 3 years, doesn't matter much. You don't have to trust me on this. Just get a silver price chart going back to 1970 and take a look at what happens to the metal when it runs. It is truly, truly, truly astonishing.
The precious metals market typically follows a cycle where gold leads in the early stages, driven by fear and risk aversion. As economic instability, geopolitical tensions, or inflation rises, gold's price increases, benefiting established producers. However, this year, silver has outperformed gold by 38% to 42%, even though gold reached an all-time high in late October. Silver is trading at its highest level since November 2012, supported by strong demand fundamentals. Demand for silver continues to outstrip supply, primarily due to its vital role in various industrial applications, including batteries, solar panels, medical devices, and semiconductors. According to the Silver Institute, global silver demand is expected to reach 1.2 billion ounces this year, marking the second highest level on record. This increasing demand has drawn more investor attention. As momentum builds, generalist investors shift focus from gold to silver, often driving silver's price higher due to its lower unit price. According to Rick Rule, the founder of Rule Investment Media, the pattern of gold leading the market before silver takes over has been evident in past bull markets. In the 1970s, gold started the decade at $35 per ounce, while silver was priced at just $1.25. By the decade's end, gold had surged to $850, while silver climbed to $50. A similar trend occurred in the 2000s, with gold rising from $253 to $1,700 and silver jumping from around $5 to $50. When market leadership shifts to silver, its price escalates more explosively than gold, though it may take longer to gain momentum. As more generalist investors enter the market, the influx of capital can outpace the available market capitalization, leading to significant price appreciation in silver. Rick believes the upside could be substantial when silver enters its major price run, likely in 2025 or 2026. While Rick is uncertain about the exact timing of this shift, the long-term outlook for silver is highly promising, with the potential for substantial gains once the market gains momentum. Now, we present the clips of Rick Rule's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
In my experience, history, I've been through, depending on how you count them, either 3 or 4 precious metals bull market cycles, some fairly short. But they followed a predictable pattern. The market was kicked off by a fear buyer buying physical gold. Gold moved first. After the momentum was established in physical gold, some of the better gold producers began to enjoy better profit margins. There's a delayed reaction to this, of course. But when that happened, the biggest gold producers began to move. And that momentum attracted generalist investors. When the generalist investor became interested in the precious metals narrative, a couple things happened. Going right to your question, perhaps because of the lower unit price of silver, leadership in the precious metals market changed from gold to silver. Silver moved later, but when it moved further and faster. Sorry to keep going back to history, but let's look again at the decade of the 1970s. At the beginning of the period, gold was at $35, price controlled. Silver was at $1.20 or $1.25. At the end of the decade, gold was at $850. Silver was at $50. Let's go back then to 2000. At 2000, gold was at $253. And if my memory serves me well, silver was at $5 or $6. At the end of the decade, gold was at $1,700 and silver was back at $50. When market leadership changes from gold to silver, silver runs further and faster. but it takes longer for it to get started. You may remember, or you may not, I looked at my notes of our last interview, yours and mine, or second to last interview at the beginning of 2024. And I had suggested to you that the high quality junior stocks as a whole were really, really, really hated. I love to triumph my past successes on those odd occasions where I was right. And I was really right. And I said, I think that these silver stocks are a coiled spring. Not because I think silver needs to do well over 2024, but rather because everybody who possibly wanted to sell these stocks has already done it. They're hated. And we've seen this weird circumstance in 2024 where the high quality silver juniors are uniformly up 2, 3, 3.5 times, while the silver price hasn't moved much. So I would caution you that it may be that in the next stage of the silver bull market, in the beginning of the market, that silver itself, the metal, might outperform the junior stocks because the high quality juniors have already had such a spectacular run. Looking longer term, again, in my experience, Doug Casey famously points out that the market capitalization of high quality junior silvers is so small. And notice that I say high quality. I'm not talking about the really junky guys. When the generalist investor becomes interested in the space, there isn't enough room. There isn't enough market cap to contain the money. From the point of view of what silver bullion does, which is to say sells silver, you won't need me to tell you when leadership has transitioned from gold to silver. My experience is that when silver runs, you don't need a crystal ball to understand it's running. It really, really, really runs. Is that going to happen in 2025 or 2026? I don't know. What I do know is that when it runs, whether you had to wait 2 years or 3 years, doesn't matter much. You don't have to trust me on this. Just get a silver price chart going back to 1970 and take a look at what happens to the metal when it runs. It is truly, truly, truly astonishing.
Despite the dollar's strength relative to other currencies, Rick Rule argues it is losing real value. He points out that with inflation around 7.5%, holding a 10-year treasury yielding 4.4% results in a 3% annual loss in purchasing power. Over a decade, this equates to a 35% decline in real value. In light of this, Rule highlights the increasing trend of central bank gold buying, which he sees as a shift in assets from west to east. The goal of these central banks, he suggests, is to create a network of nations with the confidence to trade outside the US dollar, reducing reliance on the dollar as a global reserve currency. Rick draws historical parallels to demonstrate how gold preserved purchasing power during the decline of the dollar. He points to gold's rise from $35 to $850 per ounce in the 1970s and from $253 to $2,700 since 2000, showing its effectiveness as a long-term store of value. Rule believes that gold is a reliable hedge against inflation and economic instability, noting that severe instability could push its price as high as $10,000.
I think the dollar will do well relative to other currencies. But I think the dollar will do very poorly in isolation. Let's look at the arithmetic around the US 10-year Treasury, Patrick, in answer to your question. The Treasury pays you 4.4%. And if you believe the CPI stated rate of inflation at 2.6, you're getting a 2.2% real yield. Not great, not bad. You know you're going to get paid because if they need to, they can print to pay you. But if you change your inflation assumptions to reflect real arithmetic, what you see then is that the purchasing power of your yield and your principal is declining by 7.5% compounded. Now that's brand new arithmetic. If you take 4.4 as the interest number and you subtract 7.5, the deterioration in the purchasing power, what you learn is that in a real sense, you're losing 3% a year, every year for 10 years. The US government is making you a promise, Patrick. If you lend them $1,000 today in a U.S. 10-year Treasury, they will give you back 35% less purchasing power 10 years from now, and they guarantee it. Let's look at history and arithmetic. In the decade of the 1970s, with the US dollar losing 75% of its purchasing power, the gold price went from $35 to $850, a 30-fold increase. Let's strip part of that out, just for fun. Let's say that the move from $35 to $100 was due to the legalization of gold ownership, because gold had been price controlled for, 40 years? So let's say at the beginning of the decade, just for fun, that gold was $100 an ounce. At the end of the decade, with a 75% deterioration in the purchasing power of the US dollar, gold was at $850, an 8.5-fold gain. Then let's fast forward to the decade 2000 to 2010, the last time the US dollar was under internal assault. At the beginning of that decade, the gold price was $253. At the end of the decade, the gold price was $1,700, a 7-fold increase. Or, just for fun, let's lengthen the time frame. Let's do 2000 until today. At the beginning of the millennium, gold was at $253 an ounce. Now it's $2,600, $2,700. What's that, an 8-fold increase, 9-fold increase? Gold has done exactly what it was supposed to do for the last 24 years. It has maintained its purchasing power. If I'm right, and the decline in the purchasing power of the US dollar is at 7.5%, it was less earlier, and gold increased in value by 8% compounded over 24 years, what gold did is exactly what it was supposed to do. When people with a short-term orientation, the greed buyers of gold, say, I own it at 27 because I think it can go to 3,200. That number becomes real to them looking at the immediate past. That's not why I own gold. I own gold because I have a visceral memory of the decade of the 1970s when the gold price increased in real terms 8-fold. I own gold not because I hope it'll go to 3,200, but because I'm afraid it's going to go to 9,000 or 10,000. Patrick, I would dearly love to be wrong.
According to the LBMA's annual dealer survey, 45% of participants believe silver will outperform other precious metals shortly, signaling a potentially great opportunity for investors to include silver in a diversified portfolio. Historically, silver has outpaced gold during bullish cycles, often accelerating once momentum shifts. This pattern has been seen in previous market rallies, where silver tends to experience faster price growth after gold leads the initial phase of the rally. Given these trends and increasing demand for silver in electronics and renewable energy industries, silver could be a strong investment as it potentially leads the next precious metals bull market. Could this be the right time for investors to consider increasing their exposure to silver in anticipation of the next market shift? Please share your thoughts in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.